Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger and Associates Financial Planning. I'm pleased to have as my guest today again, Thomas Balis, chartered financial analyst, CFA. Thomas, thank you very much for joining me again.
Thrilled to be here.
This is our second of 3 episodes. We did a little flip around, et cetera, et cetera. Full disclosure, this is being taped on July 19th. And because we're talking a little bit in the world of politics, not as a political statement, but right now we're going through some times where there may be some changes. But the practicality of the matter is that while we may reference the Biden administration, which is currently in office, there's question as to whether or not he remains to stay on the ticket for re-election. But to be honest with you, that has no bearing. And this is not designed to be a political statement other than more so from textbook. And I just remember back in my days, studying or whatever, is the difference between the Democratic platform and the Republican platform is fundamentally the Republicans say tax less will create more business activity, which will raise more tax revenue and which will spur the economy. The Democratic platform is tax more government spending, and that brings in more money and improves the economy. And that's just basically the platform, fundamentally textbook. From there, you obviously have changes in administrations and philosophies, et cetera, as to the specific, what their policies may be for implementation. Okay, so that's just the foundation. Again, it doesn't, we're not talking specifically about President Biden or former President Trump. We're talking about what happens when it comes to elections, and if one party wins the presidential election or the other party, what is expected, anticipated, and as we pointed out in the first episode, what they say, and this is politicians.
Yeah.
What they say in their campaign and what they actually do is not always the same thing. But, and the other thing too, give them a little bit of support, is you may have a lot of great ideas when you're president, but you got to get them through Congress.
Well, for sure, and we'll talk a lot about that. And we'll also talk today, importantly, about what the election impacts are for the broader economy and for the stock market and the bond market and your investment portfolios, because we know that there are a lot of folks that have concern about potential volatility with the elections coming, and hey, what does this mean for my nest egg? What does this mean for my retirement? What does this mean for my Social Security check? And so we'll talk about potential policies that come out with different administrations, but more importantly, their impact to the economy and to your investment portfolio.
Well, so one thing we've noticed, a very more and more divided country as it pertains to the political side. There is always the middle, and you might vote Republican, you might vote Democrat. But what we're finding is that there's a shift where the middle exists less than before.
For sure.
And sadly, you find a lot of animosity between the two parties.
Well, yeah, it's and some would point to social media as kind of an amplifier of, if you will, of the intensity of the dialogue on both sides. Where we see that disagreement is often less respectful than maybe it was once at a time, and it wasn't it's no longer the default to we'll just simply agree to disagree. It's sometimes, sadly, it's if you don't agree with my policy, then you're a bad person,
right,
or you're evil, or
right,
something along those lines. And so I think we would all really enjoy a more cordial dialogue between the parties where we found compromise and middle ground and could get some things done. And we'll have to wait and see what happens in November to see if we actually get that.
Yeah, even then between now and November and for years to come, it has been just progressively over the years been getting worse. But one thing that I will say is, and I never really understood what people meant by it when they would say the market doesn't like uncertainty. Like, what does that mean? Well, I experienced it once. Okay, I was in a lawsuit at one point years ago, and not somebody suing me or anything. It was just like a simple suit, but it was stressful not knowing the results.
For sure.
And once I found out the results, they weren't favorable. But I was relieved.
Yeah, because it was a known,
it's over.
Known outcome.
It's over. And so, is it true, and I don't know the answer to this, is it true that it's volatile and then shortly after the election, there may be a move in one direction, but it's very short-lived, but the volatility decreases?
For sure. I mean, because markets like predictability. I mean, if you stop and think about that, because the underlying companies like predictability. You know, companies want to be able to know, you know, before they make that investment in that pipeline, is there likely to be regulatory action from the administration against the pipeline? So they're going to pause on spending or be uncertain about making long-term capital allocation plans until they have confidence that, you know, forward-looking regulatory environments are going to favor that spending.
Or even if it doesn't favor, at least they know.
At least they know. And so markets like that, you know, that predictability, and that's, you know, one of the reasons that they like divided government, because if you have one party in power in the executive branch and then you have a mixed Congress, it's very difficult for legislation to get passed that makes significant changes.
Right.
And so when nothing changes, things stay the same, things are predictable, and the market tends to react favorably to that.
Right. But when there's one side, it can create regulations that may not necessarily, well, it will create more regulations, which, you know, divided government is actually sort of intended because it provides checks and balances.
For sure, for sure. And, you know, as we go into this election season, I know that just, you know, talking to friends, talking to clients, talking to advisors, you know, it would seem that there's a lot of concern about this election and what's at stake. And, you know, we have a slide that shows, you know, the crises throughout the years. You know, and it goes back into the 30s. I know for our listeners, this slide may be a little busy.
It's not just, well, it's, for the listeners, you can't see the slide. For the viewers who are looking at it on their phone, it's going to be real tough to see. But
the principle here is that regardless of what happens, whether it's, you know, Smoot-Hawley back in the 30s, whether it's the World Wars or the Cuban Missile Crisis or 9/11, markets are up and to the right over the long term, regardless of the crises. And so regardless of what happens between now and November, you know, we know that long term as investors, that markets, you know, plow through those things over the long haul. There could be short-term volatility, but over the long haul, the market's not going anywhere, regardless of the outcome. Now, that being said, you know, there are some folks that are like, you know, November is coming. It's almost like Game of Thrones, you know, like November is coming. The elections are coming. Well, let's talk about a little bit, if we can, okay, well, what happens if either party wins? Because there's some things that are going to happen regardless of who wins.
I'll tell you what's going to happen regardless of who wins. All those stinking ads on TV are going to go away.
For sure.
Anyway. I didn't mean to interrupt.
No. And believe me, by the time we get to October, we're all going to be like, oh, please.
Yeah, hit the mute button while you're
yeah, for sure. But regardless of which party wins the administration, which parties win in Congress, we know this. There's more spending and more government debt coming. You know, once upon a time, the Republican Party was the party of less spending, responsible, you know, debt management for the country. You know, that Republican Party may exist in little pieces and segments, but I think we saw in the last Trump administration that he's not afraid to deficit spend either. And there was some good that came out of that, by the way. With those lower taxes, we saw the economic pie get greater for everybody later on. But that initially leads to some short-term deficits when you cut taxes. And so we recognize that, whether it's a Republican administration or a Democratic administration, there's going to be more spending. And so with more spending, we see more government debt. And with higher government debt, that the long-term impact of that is going to be likely higher interest rates, which has broader implications across not just bonds, but also even stocks. As borrowing costs are higher, it makes it more expensive, especially for smaller companies, to take on debt to be able to grow into larger companies. And so, there's those long-term implications of all that spending. Short-term can be good. Longer-term can have some impacts.
Well, sure. It's like candy. Hey, here I have a piece of candy, and like, ooh, that tasted good, and there's sugar high and everything else like that. But look at some of the longer-term impacts, and that's. But the spending is something that, was a not modern portfolio theory, modern monetary policy, or some goofy thing that basically says, you just keep charging. But it bothers me, okay? And I look at it from the perspective of, I've been teaching taxes for 20 years, tax planning. And only a few years ago, the amount of money that we spent as a country was a heck of a lot lower than it is today. Okay, the amount of money out of our federal budget was 6% of the overall budget was the interest on our debt. Now it's almost 12%. But not even philosophically, we spend $6.2 trillion a year, and our revenue is $5.2 trillion. Well, what's your revenue? Your revenue is taxes. Well, excuse me, but if they're bringing in 5.2 and spending 6.2, that means they're having to effectively go in deficit for $1 trillion, and that $1 trillion just keeps raising our debt. And I mean, I like to put it on a more family type thing.
Sure.
Hey, Thomas, you spend $6,200 a month, but your income is $5,200 a month. No big deal, just put the other $1,000 on a credit card. But you already got $350,000 in credit card debt. No big deal, just raise the limit. What could possibly go wrong? That concerns me personally. Okay, now, it concerns me for my children and grandchildren. I just don't see the government. Why don't they see that?
Well, unfortunately, we have a government that, if you'll forgive the term, have almost become a group of last-minute Lucy's, where they refuse to deal with anything until it's almost a crisis. And
such as Social Security?
Yeah.
Okay.
Yeah.
Anyway.
And more importantly, Medicare. But the reality of it is that in the short term, we'll be okay. Even with this spending, which I'm not a fan of. I don't like deficit spending. But, it's manageable for now until it's not. So the next 10 or 15 years, regardless of which administration's in power and the fact that they're deficit spending and we know it's coming, it's going to be manageable. But in 10 to 15 years, you end up with this hockey stick of problems where demographics and people retiring and fewer people paying into the system,
that's already happening.
The costs go dramatically up. And so it's not a problem, and it's not an investment problem for today. But to your point earlier about our kids and grandkids, 10 to 15 years from now, it becomes a real problem. And it's something that, again, when it becomes urgent, that's probably when they'll take action on it. But for now, we'll continue to plug away, and sadly probably have higher interest rates in the coming years because of it.
Yeah. Why does it impact the interest rates?
Yeah. So, bond investors. I mean, if you think about it, back to your family example, right? If your brother-in-law Bob is the one that's spending the $1,000 a month and he's got that $350,000 debt, say Bob wants a new credit card. Well, if I'm making Bob a loan or giving Bob a credit card, and Bob's got $350,000 in debt, I'm probably going to charge Bob a higher interest rate
because of the risk
than I might my friend Mike, who is very conservative with how he spends his money, because of the higher risk. And so, and there's some talk that the bond vigilantes, could come back and insist on higher interest rates at the long end of the curve. And that's one thing it's important to understand. So the Federal Reserve controls short-term interest rates, the overnight lending rate that banks can charge to one another. That currently is set at 5.25% to 5.5%. Longer-term interest rates are determined by market forces. What bond investors are willing to pay for a bond at a certain coupon. And so when they become less willing to buy those long-term bonds, the price goes down, the yield goes up. And so, we saw this happen in the UK not long ago, where a very short-term prime minister tried to put together, some policies that were going to be spending significant deficits, and their bond markets absolutely put the brakes on that. And it wasn't 2 weeks later she was out of office. And so, our politics work a little bit differently here in the U.S. But at some point, markets will refuse to continue spending the bill. And we'll talk a little bit more in the next episode when we talk more about future Fed policy, about foreign investors and bonds and so forth.
Okay, we're at a good point for a break. What we'll do when we come back is we'll talk about what we anticipate with a Democratic victory versus a Republican victory and the impact, so to speak, on their policies and the markets, et cetera, et cetera. So if you'll stay tuned, we'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and where we were talking in the first segment is a little bit about Fed policy, not as much Fed policy, but the impact of interest rates at the election and government spending, et cetera, et cetera. Now we're going to talk a little bit about a Republican victory versus a Democratic victory, and I came up with a really cool idea during break. Okay, I have a red pen and a blue pen in my hand. What I'm going to do is put behind my back, and I just dropped one. You looked. So whatever one I dropped is the one that we're going to do second.
Okay.
Blue.
Okay.
All right. I guess we're talking about Democratic victory. So what happens if the Democrats win?
So, we know in general on their platform, and again, regardless of whether it's Biden on the ticket or Kamala Harris or some other change that happens, depending on, just how things happen between now and the Democratic National Convention, we know in general that the Democratic platform favors higher income taxes, higher corporate taxes, and especially higher taxes on those, I think, over $400,000 a year on the individual side. There's talk of taking corporate rates from 21% to 28%. And in general, a Democratic administration tends to favor higher spending, and tends to be less business friendly. And so when you think about, what does that have an impact in the markets? Well, if you have higher taxes, that actually tends to slow things in the economy, because if you're paying more to Uncle Sam, you have less to spend out of your pocket to keep the economy going. We know consumer spending drives 2/3 of the economy or more. That gets made up in some ways by higher government spending. And so depending upon the impacts there, you could have short-term and intermediate-term impacts to the economy. And then the less business-friendly piece. Again, businesses are going to be less likely to invest, less likely to make long-term spending plans if they fear, more regulatory impacts, less likely to engage in maybe mergers and acquisitions if they fear, pushback or potentially getting sued and the merger not being able to go through. So those are all potential impacts that you might see in a Democratic administration.
Okay. So what about Republican administration?
Yep. So, typically Republican administrations tend to favor lower taxes. And so I know their platform currently calls for extending the TJTC tax cuts that are scheduled to expire in 2025. There's talk of no tax on tips. There's talk of lowering the corporate rate further from 21 to 15%.
Oh, really?
And there's certainly talk of higher tariffs. And so on the one side, lower taxes could be good for the economy. Companies have more to invest back into their business, grow the pie more for everyone. Consumer spending can increase. That can drive the economy higher. But those things can also be inflationary, Mike. I mean, if you are spending more, then that can drive prices up. It's all about supply and demand. And so there's some impact, and certainly tariffs are very inflationary in the short term. Now, in the long term, you would expect other providers to maybe grow domestically and provide alternatives at lower prices than maybe the tariffs. But in the short term, they can be quite inflationary. And so if inflation rears its head back, that can have a significant impact on interest rates.
So in that case, when President Trump was in office, he lowered taxes, and on both the individual and the corporate. Didn't the corporate go from 28 to 21?
It did.
So given what you just said, all these things are inflationary. We didn't experience inflation during that period.
Well, there's...
Or market, you were 1.5, maybe 2, something like that.
Yeah, for sure. And there's part of that is that you've got, the tax law didn't become in effect until halfway through his term. Right?
2018.
Yeah. So there's that piece to it, and then policies act with lags, right? So not to say that these things are dramatically inflationary. I'm not suggesting that these policies would bump CPI back up to 8 or 9%. I'm saying it will be hard for the Federal Reserve to continue getting inflation down to the 2% target in the face of these kinds of things.
Okay. So you answered the one question that I was about to ask, is the tax cuts that were implemented by President Trump in 2018 were set to expire at the end of 2025. Okay, which, by the way, every time they do this, they always set the expiration to be in the middle of a presidential term, which makes sense because no president, I don't care who it is, particularly if you're a new president, it's very difficult for you to be able to walk in and change on a dime any tax laws.
For sure.
But that doesn't give them a lot of time. So you were referencing the concept of, if President Trump wins, that he's looking to lower the taxes. Like, for instance, the taxes are supposed to revert back to the prior tax cuts that were implemented by President Bush in 2001, which I was preaching for years, that those are the lowest taxes we've ever been in. They can only go up. And of course, President Trump made a liar out of me. But are you saying that President Trump actually is looking at lowering the taxes from where they currently are?
So I don't think, well, it depends on who you are. Certainly if we're not taxing tips, which, that's a significant my daughter works in a restaurant that impacts a segment of the economy. And so that would be lower taxes than what you have now.
It's a smaller segment.
I think the current policy, though, that from what I've heard on the income tax side, is to simply extend the existing program beyond 2025 and make it permanent. It's the corporate side that there's discussion of further lowering the tax rate rather from 21 to 15%.
All right. So on that note, if President Biden wins, is he talking about doing any type of, forget Biden, whether it be President Biden or the Democratic Party? Are they talking about, I thought I heard they were going to extend them also, but not for the people over 400,000.
Yeah, so the policy's been a little muddy, but the core line that you've heard the administration preach is that, that taxes aren't going to go up for anybody that's making less than 400,000. And so there was talk basically in essence of extending the tax cut, the taxes for folks that are below that income threshold, but then for folks that are above it, going back to that higher, marginal tax rate of 39.6% that we had before the TJ.
Which isn't extraordinarily higher than the current 37. I mean, it's not that big of a move. But it's just interesting. So by the sound of it, both parties are actually looking at extending the existing tax code?
Well, I mean, there's look, if the way it gets framed is that if you don't if you don't vote to extend them, then you're voting for higher taxes. And politicians don't like to be, tagged with raising taxes on people unless it's on the rich. The rich.
It's easier to sell.
The rich is easier to sell. They got to pay more of their fair share. But they definitely don't want to get seen as raising taxes for average working people or people that aren't considered affluent. And they've drawn that line at 400,000 is what the current administration has drawn that. But regardless of whether we see a Biden administration or a Trump administration, I think one of the things that we have to consider is, do we end up with divided government, or do we end up with more of a sweep type government? Because I think that's going to have an impact on exactly how far tax policy can change.
Right. Well, I mean, fact of the matter is that if you have a Republican victory at the White House and the Senate and the House, then effectively they can, within reason, do whatever they want. Similarly, if you have a sweep of the Democrats win the White House, the Senate, and the House, then they can do whatever they want within reason.
Within reason, so because you still need 60 votes in the Senate for a lot of things, and so unless you'd have a dramatic sweep, I don't think that's currently on the table for most pundits. But back to our earlier point, Wall Street does like divided government, because with divided government, you don't see big radical changes. Right. You see more measured changes because they have to compromise, and so less change means more predictability, and Wall Street likes predictability. But if we were to see a sweep election, and in particular, there's talk, at least in the news as of this taping, that a Republican administration is more likely, and potentially that could come down ballot. Although I think the pundits were calling for maybe a Republican Senate and maybe a Democratic House, but who knows? My crystal ball has been in the shop for years. And
well, I've got a crystal ball, but it just never came with instructions.
Gotcha. So, but if you do see a sweep,
what's that going to do to the markets?
Well, it's going to create less predictability and more volatility, because if you don't have a check on those changes, then all of a sudden uncertainty creeps back in. If you're, say, for example, if you're a Republican administration, you might see less green energy spending than what you might see in a Democratic administration.
So that'll impact certain industries.
And
similarly, I guess the Republicans believe a little bit more in the use of fossil fuel, which means that the energy sector will probably do well with a Republican sweep. Would you believe that?
Absolutely. And I even heard during some of the convention this week that it's not so much that there would be a massive reversal of the existing green energy plans around solar and wind and stuff like that. The thought is that AI is going to need so much power in order to fuel these massive server farms, that we're going to need all the energy that we can produce, not only on the fossil fuel side, but also
on the solar and the wind. And that's
sure.
correct.
So you're going to need both. And so it's less likely that those policies will roll back aggressively. You just won't see further increased spending. But again, with fewer checks against an administration where they have carte blanche, if you had a all united Congress and administration, then you could see bigger policy changes. And so,
and that's where you probably may find certain segments of the market may do really well and certain segments of the market not do well, or at least projecting if that happens. Now, I would also think that if there was a Democratic sweep and the expectation of raising the tax rates for the wealthier, that would actually bode well for the municipal bonds, wouldn't it?
Well, you would think, but tell me a little more what you're thinking.
Well, I mean, if the tax rates go higher, then I'm going to want to buy the tax-free bonds, and it's going to create a demand for the tax-free bonds. But
yeah, so if more people are investing in the municipal bonds, then the yields are going to go down because prices are going to go up. So yes, it'll be good for bond prices.
Right.
But the yield will probably come down if you get a pile of money that's going in that, for sure.
Well, and then I guess the other thing you can also point out is that the opposing force would be, what's the overall interest rate environment? And if the overall interest rate environment is under pressure, then that will also put both taxable and tax-free munis under pressure.
Yeah. Well, I think the important thing for us to remember, and we mentioned this earlier, is if we do have a sweep where you see more significant change, the reality is that over the long haul, right, whether you have a divided government, whether you have a full-on Republican administration, or whether you have a full-on Democratic administration in Congress, that markets favor well over time. And we have a chart that illustrates this.
Let's look at that real quick because we're almost out of time.
Whether you see the blue columns or the red columns, whether it's a Bush administration, a Reagan administration, a Clinton, an Obama, a Trump, a Biden, the markets are going up and to the right, regardless of really who's in charge. Because, again, more often than not, there's divided government for at least part of those administrations, and these policies act with a lag, and there's only so much change that they can enact. And so from an investment portfolio perspective, we remain confident that markets will continue over the long term to be a great place for folks to invest and to plan for retirement. And whether we see a Republican administration, a Democratic administration, whether we see divided government, whether we see a sweep, at the end of the day, I think markets in 2025 are higher than they are now.
Right. And every CFA says that. Would you believe it? You must teach that in CFA school or something like that. No, it's kind of funny. But one of the things, and I'm going to wrap it up with this, is that it seems as every 4 years, you keep getting all of this influx to your email inbox talking about it. And one of the things that they've demonstrated is that it is statistically insignificant as to who's actually in office.
Absolutely. I mean, the reality of it is that when you look back at the data, that there's not enough of a difference to be statistically meaningful. Like
Correct. That's what I'm saying.
Yeah. So there's regardless of who wins, we know that the U.S. markets are the best, strongest markets in the world, the most clearly regulated, and the best place for folks that are saving for retirement to have a significant portion of their assets.
Right. I've always liked the U.S. anyway. So, anyway, I thank you very much, Thomas, again. Thank you very much for joining us once again. As I said at the beginning of the episode, this was taped on July 19th. So it is entirely possible that things may have changed. But fundamentally, the stock market is based upon earnings of a stock, earnings growth, its dividend, and its dividend growth. And those are the fundamentals. The daily volatility is the emotion. So the long and short of it is, do not let the elections impede your thought process onto what you do.
For
Would
sure.
you agree with that?
Absolutely.
That's our conclusion. Well, thank you very much for joining us. I look forward to having you for part 3. Part 3, we're going to be talking more again about Fed policy and what the drivers have been in the markets in 2024 and potentially beyond. Well, thank you for joining us, and thank you again, Thomas. Have a wonderful day.